What if you could get paid for holding stocks forever? Imagine a portfolio that grows year after year and pays you consistently, rain or shine. In this video, we reveal 5 dividend legends that the smartest investors never sell. Welcome back. Today, we're diving into the top 5 dividend stocks to hold forever. Companies so strong, so consistent, that they become investor favorites for a reason. These aren't just about dividends. They're about reliability, recession resistance, and real wealth building. If you're building a long-term portfolio designed to generate income and stability, these picks will upgrade your financial future. Stick around till the end for a surprising tech stock that's quietly becoming a dividend machine. Here is TH's list of stocks name. 1. Johnson & Johnson J&J, the healthcare fortress. 2. Procter & Gamble PG, the dividend king of daily life. 3. Realty Income, the monthly dividend machine. 4. Chevron Corporation CVX, the energy giant that pays big. And the last is Microsoft MSFT, the tech titan with a rising dividend. So, without any delay, let's dive into the video. First one is Johnson & Johnson J&J, the healthcare fortress. Company introduction. Johnson & Johnson is the gold standard in defensive investing. Founded in 1886, this healthcare titan operates across 3 segments: pharmaceuticals, medtech, and consumer health. With a global presence in over 60 countries and a trusted brand legacy, J&J is more than just a dividend stock. It's a safety net for your portfolio. Market cap, over $373.45 billion. Stock price, $155.21. Dividend yield, 3.35%. Dividend growth streak, 63rd consecutive years. Over the past 3 years, J&J's share price has delivered modest growth, 15%. But that's not why investors love it. The company's ability to consistently grow its dividend, through thick and thin, makes it a true dividend aristocrat. Even during 2008 and the 2020 pandemic, Johnson & Johnson didn't just survive, it outperformed the market. After its 2023 spinoff of Renview, Johnson & Johnson streamlined its focus on pharmaceuticals and medical devices, 2 high-margin, high-growth sectors. It has blockbuster drugs like Stelara and Darzalex, and its medtech division is innovating in surgical robotics. Key growth drivers. Its drug pipeline, especially in oncology and immunology, looks strong through 2030. Plus, its AAA credit rating and fortress balance sheet mean it's one of only 2 U.S. companies with such financial strength, the other is Microsoft. Analyst sentiment. Most analysts give Johnson & Johnson a strong buy or hold, citing predictable cash flow, global diversification, and stable dividend income. Conclusion. If you want a foundational stock that delivers peace of mind, solid income, and recession-proof performance, Johnson & Johnson is a must-hold forever. Second is Procter & Gamble PG, the dividend king of daily life. Company introduction. When it comes to brands you use every single day, think Tide, Pampers, Gillette, and Crest, Procter & Gamble dominates like no one else. With a legacy of over 180 years in operations in 180-plus countries, PG is the king of consumer staples, an elite dividend king with 67 years of consecutive dividend increases. Market cap, over $398.31 billion. Stock price, $169.89. Dividend yield, 2.49%. 3-year performance, approximates 69 consecutive years with consistent dividend growth. PG's moat is massive. They sell products that people buy no matter what's happening in the economy. That's why, during the 2020 crash and even the 2008 crisis, Procter & Gamble remained resilient, outperforming broader indices. Its focus on core business efficiency, cutting underperforming brands, boosting margins, and leveraging AI in supply chain operations, has made the company leaner and more profitable. With high pricing power, PG has navigated inflation better than many peers, passing cost increases onto consumers with minimal volume loss. Key growth drivers. Its premiumization strategy, higher margin product lines, expansion into emerging markets, and heavy investment in automation and sustainability are fueling next-gen growth. PG is also exploring more e-commerce-driven direct-to-consumer channels, which have grown steadily since 2021. Analyst sentiment. Wall Street views PG as a buy or stronghold, especially attractive during uncertain macro conditions due to its defensive nature and strong cash flow. Analysts also point to its payout ratio of 60%, suggesting room for future increases. Conclusion. If you're looking for a high-quality, recession-resistant dividend stock with unbeatable brand power, Procter & Gamble should be at the top of your list. We've covered 2 dividend giants that are built to last. But up next, we're going into real estate, energy, and even tech. Yes, a tech stock that's quietly becoming one of the most reliable dividend payers in the world. If you're finding value so far, smash that like button to support the channel and hit subscribe so you never miss a high-yield opportunity again. Let's dive into our third forever dividend stock. So far, we've covered 2 dividend giants. Third is Realty Income. Company introduction. Realty Income, famously known as the Monthly Dividend Company, is a real estate investment trust REIT that pays out dividends, you guessed it, every single month. This consistency has made it a favorite among income-focused investors, retirees, and portfolio builders seeking regular cash flow. Market cap, $51.13 billion. Stock price, $56.62. Dividend yield, 5.61%. 3-year total return, -6.04%. Realty Income owns and manages over 13,000 commercial properties across all 50 U.S. states, plus international assets in Europe. Its tenants include highly stable businesses like Walgreens, 7-Eleven, FedEx, and Dollar General. The kicker? These are all long-term triple-net leases, meaning tenants pay property taxes, insurance, and maintenance. That's low overhead for Realty and high reliability for you. Its business model thrives on predictability. Realty Income collects rent every month and pays it directly to shareholders. It has paid and raised its dividend for over 100 consecutive quarters. During COVID-19, while other REITs slashed payouts, Realty held firm. Key growth drivers. Strategic acquisitions, like its $17 billion merger with Realty, and expansion into Europe have diversified its portfolio. Its tenant base is now more recession-resistant than ever. Plus, new sectors like data centers and logistics hubs are adding fresh growth streams. Analyst sentiment. Analysts rate it as a buy, noting its strong balance sheet, recession-proof tenant profile, and rare monthly income structure. It's seen as undervalued when interest rates stabilize. Conclusion. For long-term investors seeking consistent monthly cash flow with diversification and inflation protection, Realty Income is about as dependable as it gets. Fourth stock is Chevron Corporation, CVX. Company introduction. If you're looking for energy exposure with powerful dividend consistency, Chevron is a blue chip to watch. Founded in 1879, Chevron is one of the world's largest integrated oil and gas companies, with operations spanning from exploration and production to refining and renewables. Market cap, $238.78 billion. Stock price, $136.70. Dividend yield, 5%. 3-year performance, plus 33.89%, stronger than many growth stocks. Chevron has paid dividends uninterrupted for over 100 years, and it has increased them for 37 consecutive years, making it a dividend aristocrat. Its robust cash flow enables it to reward shareholders, even when oil prices are volatile. Unlike many in its sector, Chevron is conservative with debt and aggressive with returns. One of its biggest strategic wins? The 2023 acquisition of Hess Corporation, which gave Chevron direct access to Guyana's fast-growing offshore oil reserves, considered among the most lucrative in the world. That, along with rising LNG exports and investment in renewable fuels, positions Chevron for strong future cash flow. Key growth drivers. Chevron's CapEx discipline, expanding LNG operations, and massive upstream portfolio offer long-term upside. It's also investing in carbon capture, biofuels, and green hydrogen, which balances risk and transition to cleaner energy. Analyst sentiment. Wall Street sees Chevron as a strong buy for dividend-focused investors, particularly those looking for inflation-hedged income. Its payout ratio is conservative, and free cash flow continues to exceed expectations. Conclusion. For a mix of high yield, global energy exposure, and stability in turbulent markets. Chevron stands out as one of the most investor-friendly dividend stocks you can hold long-term. And the last stock is Microsoft MSFT, the tech titan with a rising dividend. Company introduction. You might not think of tech when you hear forever dividend stocks, but Microsoft changes the game. This $3 trillion software juggernaut isn't just a leader in cloud computing, AI, and enterprise software. It's also a reliable income-generating machine. Market cap, $3.42 trillion. Stock price, $460.36. Dividend yield, 0.72%, modest but fast-growing. 3-year price growth, plus 36.88%. Microsoft started paying dividends in 2003 and has increased them every year since. While its yield is lower than traditional dividend stocks, the growth rate is exceptional. Its payout ratio remains under 35%, giving it room to increase dividends for decades without compromising innovation or cash reserves. With Azure, its cloud platform, growing at over 20% annually in dominance in products like Office, LinkedIn, and GitHub, Microsoft generates over $100 billion in annual free cash flow. It's one of the few tech companies that combines extreme growth with income stability. Key growth drivers: AI integration across all services, including Copilot and Office 365, ChatGPT in Azure, and OpenAI investments, position Microsoft at the heart of the AI revolution. Meanwhile, the company's cloud contracts with governments and enterprises lock in recurring revenue for years. Analyst sentiment. Microsoft holds nearly unanimous strong buy ratings. Analysts praise its ability to scale, while still rewarding shareholders, and the dividend growth is expected to accelerate over the next 5 years. Conclusion. For investors looking to blend cutting-edge innovation with rising passive income, Microsoft is a rare gem in tech, a stock you buy, hold, and forget, while it quietly builds your wealth. Conclusion. Let's recap the dividend powerhouses we've covered. 1. Johnson & Johnson, healthcare giant with a 61-year dividend streak. 2. Procter & Gamble, recession-proof consumer staples king. 3. Realty Income, the monthly dividend machine built on real estate. 4. Chevron, high-yield energy leader with global dominance. 5. Microsoft, tech titan turning growth into dividend gold. Each of these stocks brings stability, reliability, and real long-term income potential. Whether you're planning for retirement or building wealth in your 30s, these companies are designed to last and pay you every step of the way. Which one is your favorite? Drop it in the comments. And don't forget to like, share, subscribe, and hit that bell for more high-quality stock insights. Until next time, invest smart, live rich. Signing off.